you don't know where to begin, better ask Win.
Shane, good to see you. Today we get to talk through how to minimize capital gains tax. So we're going to talk through a few strategies that range from timing to charitable giving to certain investment techniques. So let's start by explaining when you are on the hook to pay capital gains tax. What do we need to know?
So this is always talked about when we're talking about money that's not in an IRA or not in a Roth. So this is non-qualified money. Of course, if you make money in that account, then the gains become taxable.
Okay, so now let's talk through a few strategies to minimize those taxes. And the first strategy would be to pay your taxes now while we are living in a historically low tax rate environment.
Well, as painful as it may seem, a lot of times it does actually make the most sense to just pay it all at once, get it out of the way. Now, we've looked at strategies of spreading it out over time, and we've had CPAs that have actually agreed with us in that paying it all up front, getting it out of the way, usually makes the most sense as far as minimizing tax over the long term.
Mm-hmm. The second strategy is known as tax loss harvesting. So how does this work?
Well, this is an interesting strategy. And basically what it means is you have, let's say you have some stocks that have gained quite a bit. You have some other stocks that have also lost a little bit. If you move those stocks kind of together, you sell them all at once, you can use those losers to help offset the gains that you have in other areas. And therefore you can kind of average out your tax and keep it a little bit lower. So when you see red in your non-qualified account, it might not actually be the worst thing in the world because it, again, can offset some of your gains elsewhere in the account.
Interesting. All right. And next, you need to make sure that we hold that asset for more than a year. Why is that?
Well, when you hold a stock, let's say, for over a year and you sell it for a profit, that tax switches from an ordinary income tax to a capital gains rate tax. And typically that's going to be about 15% as opposed to your tax bracket for income, which could be 12, 22, 24, something like that. And that's a fairly big difference.
Mm-hmm. And now you mentioned there are some more advanced strategies that people could consider.
There are. So we have things like charitable remainder trusts, donor advised funds that can help higher net worth individuals really minimize their tax obligation on highly appreciated assets. And those are very advanced tools, but very powerful as well.
All right. Well, clearly some advanced math that goes into this. So if somebody wants to talk through again how to minimize their capital gains tax, how can they reach you?
Best way to reach us is online at winstonandcompanies.com or visit us via phone here at the office, 602-456-1928.
Great. Shane, thank you.
Thanks, Erin.
Got a plan for your retirement, 'cause you know it's just down the road. But if you don't know where to begin, better ask Win.